Hope everybody is having a good day. Today I wanted to follow up on the video I did last week on stock splits. I talked a little bit about ETFs, so I wanted to give the ETFs a little bit of love here. I thought it would be good to do a brief video on this subject, diving a little bit further into what they are, pros and cons, all that fun stuff. So to visualize what an ETF is, picture a gumball machine. Only this gumball machine doesn't have equal-sized spherical chews. In this machine, the gumballs vary greatly in size, some taking up 5 or 10% of the space, while others may take as little as 1/10 of 1% of the space in the machine. Here, the big glass holding container is the ETF itself, while each gumball represents a publicly traded company. Now, conversely from the standard operation of a typical gumball machine, you put your quarter in, you get one gumball out. Here, you're going to put your money into the machine, you're going to pay the share price of the ETF, and then you're going to get all of the gumballs in the machine. Congrats! So you now own a slice of each representative company in the ETF that you purchased. ETFs can be bought and sold throughout the daily trading day. Typically, they provide more liquidity and price discovery. What I mean here is, so you're going to know right away what price you bought or sold. Whereas with the sibling of the ETF, the mutual fund, the holdings in those settle up after trading hours at what's called NAV, net asset value. And you buy or sell after the market is closed based on whatever the NAV is. Why ETFs? Why are we talking about ETFs? Well, ETFs are a great tool. They offer investors a cheap liquid vehicle to get exposure to all or many of the companies that are driving today's growth and innovation. Or maybe you want a broad index-based ETF like the S&P 500, NASDAQ, Russell 2000 small cap, maybe the emerging markets. They have plenty of those. Maybe you want a very specific subsector ETF with a high concentration to like 25 or 50 different names. Think cybersecurity, solar, semiconductors, you name it. They have an ETF for every sector, every subsector that you can think of. Send us an email, talk to us on how to research and explore the best options for your portfolio. Now I want to get into fees. Just like mutual funds, ETFs have what's called an expense ratio. Most online brokers have now done away completely with trading commissions. They have brought them down to 0. If you're with an online broker that charges you more than 0, you should start exploring other options. Okay, anyway, the expense ratio is basically what you pay the ETF sponsor or manager to buy, sell, and weight each holding, each stock. How much of each stock are they going to buy in the ETF? Why do I want to talk about fees? Well, historically, fees over long periods of time have been shown to have a very large effect, both good and bad, on your overall performance. You really want to keep your fees in whatever funds you are buying, mutual funds, ETFs. You really want to try to keep those fees under 75 basis points. If you're using index-based, overall broad market stuff, you should try to be under 25 basis points. That is a quarter of 1% is 25 basis points. So just to look at the numbers, for every $10,000 you invest, if you're paying 25 basis points, that's going to be $25 for the entire year. Again, doesn't seem like a lot, but I've looked at all the research. If you're paying 1% or more over time, that has a huge factor on what your overall balance and performance is going to be 20, 30, 50 years down the road. So we've talked a lot about the benefits. I just wanted to get into some of the cons here. One of the biggest things is that you don't have any control over when the ETF sponsor, when they sell positions within the ETF. This could potentially trigger capital gains. However, unlike mutual funds, ETFs actually have a very cool, unique way to mitigate the capital gains distributions that typical mutual funds pay out to shareholders. Send us an email if you want some insight into that cool strategy that they utilize for the benefit of ETF holders. Of course, capital gains are still part of this topic here because just like stocks, if you sell a stock at a gain, you're going to incur capital gains, whether they be long-term or short-term, depending on your holding period. Same applies with ETFs on the capital gains side. Dividends, similar to stocks, but ETFs have their own unique rules, depends on your holding period. Send us an email for those as well. sorry to brush through some of these topics, but I really try to keep these videos as short as possible, cram as much useful information. But we are a resource for you. Send us an email if you'd like to talk more about the dividend portion of the ETFs. Just want to summarize here for everybody, the ETFs, again, a great tool. They're cost effective for you all to gain exposure to large indexes or maybe sectors in which that you might be interested in. Long-term investors without the time or the desire to pick individual stock names or research individual managers, again, these are a phenomenal tool for your asset allocation. Email us to discuss all of the different ETFs, which ones might be a great fit for your portfolio. Thank you all for the time. Always appreciate it. And we look forward to seeing you on the next one.